dollar index and bonds. Hi, it's Charlie giving you Wednesday's update. I literally just had a question come in earlier from on the channel here saying, could you possibly do a video on bond markets and the dollar index in relation to currencies? And so, yeah, sure. This is a chart of the 2 year bond yield. So a lot of the time we're looking at those yields, not the bond chart of the bond itself. So at the moment, as it stands today, so the daily chart, the yield is 4.2%. So what that's saying is if you bought a 2 year bond right now, then it'd be paying you 4.26%. Provided you hold that bond to maturity, you will get your initial investment back plus that yield over those 2 years. So investors will look at that. So imagine just a month or so ago, back in early-ish March, investors who bought 2 year bonds at that point were getting locked in at a 5% yield over those 2 years. And so the yield is moving up and down in alignment with what the bond is doing, so the bond itself. So as the bond itself appreciates, the yield goes down. As the bond itself depreciates, the yield goes up. So we're seeing, in effect, bonds themselves going down right now as the yields are going higher. Now, how does that affect the dollar? So that was the question. Generally speaking, we tend to find that, or you will tend to find that higher yields is more supportive of the dollar. Lower yields are normally act as a headwind to the dollar. So if, for example, I zoom in just a little bit now, we can see bond yields, I say bottomed, but from this low point here on the 6th of April, if we go over to the dollar index itself, there's there's the 6th of April there. So you can see that actually it's not the best of examples right now, but generally speaking, we would normally, and in normal conditions, if I go back to the 2 year yield, normally we would be seeing, if yields are going higher, we would normally expect to see the dollar pushing higher. So overall, it's just it's been up, it's been down, and it's about somewhere around the same level as the 6th of April. So normally that's what we would expect. And on the day today, we can see that those bond yields are up and the dollar index is up. That's what we would normally expect. But correlation wise, nothing is exact. Nothing is exact. So there will be times whereby, if we go back to the 2 year yield, there will be times. So you would normally expect, for example, here, when bond yields were falling, that the dollar itself would be falling. So let's go back to the 9th of March. So if we now go to the 9th of March, probably over here, when bond yields are falling, we'd normally expect to see the dollar to be falling, which we did. So that's fairly normal, as we can see there. So yields coming down and the dollar index coming down. But there are times when it's not quite in alignment. But as a general rule of thumb, when yields are rising, that's normally supportive of the dollar. And I have to say normally because, like I said, it's not an exact correlation, but as a general rule of thumb. And when yields are falling, normally that means the dollar is more likely to find headwinds. And so if we go back to that 2 year yield there, what's been going on over the last 2 weeks is that we can see we've been seeing upside in those yields. If we go back over the last 2 weeks, actually the dollar index is it's been a little bit lower and then bounce back a bit. So a little bit of both going on. So there are other factors that, of course, will affect the dollar index itself. Obviously the economic news releases, what's going on in that respect. If the economic, if on the economic front there's poorer data being released, then again we would normally expect that to act as a pressure on the dollar. However, and this is a really good example, when there's poorer data being released, yes, there's an argument that poorer data equals a weakening US economy, which could equal a weakening dollar. However, there's a counterbalance. If that's fine, and we've seen a lot of that over the last year, but just in recent months, we've seen weaker data come out, and the market get a little bit scared at times when there's been worse data coming out. A bit like last Friday, when we had those weaker retail sales come through out of the US, and yet the dollar appreciated last Friday. You can see the dollar went up. So because what can sometimes happen is all of a sudden investors get a bit fearful, and money tends to go into safe havens like the dollar when money gets fearful. So there's that trade-off between weaker data, but if the market starts to sense that oh no, this data's too weak, then it gets fearful, and then that can actually benefit the dollar. So there's all sorts that goes on with all these correlations and what goes on with data, and the narrative is important. So over the last year, the market was wanting bad data to come through, and so it was wanting to see the US economy cooling off, and if that's the case, then then inflation may top, and therefore interest rates may not go as high. But there is this point where the market then says, well, actually, we don't like this data anymore. This data actually is now, oh no, the US economy is slowing down. And then what you see is at some point a sell-off in equities, and actually the dollar rising as money goes into safe haven assets. So there's all this stuff going on. But coming back to the original question, when you tend to see the bond yields rising, you tend to see that being supportive. And I have to say you tend to see, because it's not like every single day that, oh, bond yields are up, therefore the dollar must be up. It's not quite like that. But as a general rule of thumb, we would at least see it as acting as a tailwind to the dollar. So even if the dollar's trying to sell off a bit, if yields are up, then it's more likely they'll act as a bit of a support to the dollar, and vice versa. So if yields started to roll back over, then we'd be more likely to see the dollar fall as well. Hopefully that gives you some food for thought there on this midweek Wednesday video. I shall see you at the weekend.